In this video, I want to determine whether SoFi Technologies actually has a competitive advantage against its other competitors in the banking and financial industry. And although the stock has been crashing recently, history shows us that bear markets are the best time to acquire stocks in companies that you believe in the long term. This is why this video in particular is so important, so if you could, share some love and give this video a like down below. And to determine whether SoFi even has a competitive advantage, we first have to understand that the finance industry is unique in the fact that it's on a list of very few industries that where the companies with the deeper pockets do not always win. To be truly disruptive in the finance space, you have to worry about the interest rates that you're collecting and the margins that the business has, and not necessarily on the assets under management. So knowing this, the rates that a banking institution can set for their loans versus the funding cost of those loans determines how fast that bank can grow overall. And this growth is set by how the bank actually creates demand and finds cheaper supply. And this is where a fully regulated bank charter license really stands out in the space, and SoFi has one. You then don't need to find any supply to fund your loans within the business, because you can use their own deposits from your clients' checking and savings accounts or any other depository account. And not to mention the fact that a lot of our competitors only have cash management accounts because they're not fully regulated banks. So they have to find sponsoring banks to actually have custodial rights on that money, so then they can take deposits of their client's account, for which those banks actually charge a fee for that service. And by the way, SoFi is one of those companies that are charging fees for this service for other cash management accounts, but we'll talk more about that later. And to put it into perspective, the funding costs on SoFi's loans used to be 3% before we actually had a banking charter. Now it's only 1%, which could mean a total reduction of around 66% just by having a new chartered banking license. So this can make all the difference between the regular neobanks that don't have banking licenses, and so they can't offer large interest rates to the consumers, versus, SoFi, who's offering 1.25% in their checking and savings accounts, which means that we can still attract new customers while also keeping margins high. But let's dive a little deeper and find out who actually is our competition. I've broken it down into three separate groups. You have the legacy banks, the neobanks, and the fintechs. So starting with legacy banks, they're obviously the biggest out of the three, but they don't go without some massive issues. So as you may know, some older customers value having a physical bank location where they can actually go in to do their banking. And so big legacy banks all have thousands of branches that don't technically add any new revenue, but they do add tons of new expenses. They have to continuously add new staff, hire new security, and pay rent on all of those buildings. So the problem is that these banks have very thin margins in order to compete with these neobanks and fintechs, even though they're offering a very similar product. But good thing that they have chartered bank licenses in order to compensate for these massive costs. This leaves neobanks and fintechs more competitive in the long run to pass on more of the savings of having no physical locations in the form of lower account fees and higher interest rates for the consumers. This is making the growth of the overall total addressable market of digital-only banking quickly rise as more products become available by online-only means. But now, SoFi's member growth is nearly doubling every single year since 2019. This is massively outperforming the overall market growth, which means that SoFi is taking a higher percentage of the market share. But by far, the biggest argument against SoFi's competitive advantage is the fact that there's so much competition and it's heating up every single day. And it's true, we're not even the biggest player in town, but we might be whenever it comes to actual earnings. But even when comparing to the other biggest players in this space, most of them do not even have fully chartered banking licenses. So these companies have to use a sponsoring depository institution to be able to even take the cash for their clients. Vero may well be the only real competitor that we have on this list, considering that they're a fully digital online bank that actually has a fully chartered license. This allows them to keep costs down and stay profitable in an ever-increasing competitive environment. Most of the time, these companies don't even have banking licenses, and they surely don't try to compete with rates. Their real goal is to actually try to differentiate the product itself and try to change the user experience. So considering how important the bank charter is to truly compete in the finance sector, the only real players are the legacy banks with too many branches that don't add anything, or the low-expense fintechs that still have to find a sponsoring bank, which takes away that extra portion of profitability. Now, looking more specifically at SoFi itself, one of the most competitive advantages that we have is the fact that we offer every financial product that you could want in one specific app. Whether it's savings, stocks, crypto, a credit card, our loans, or even insurance, we have it all under one roof, and that's why they call us the one-stop shop. But now I want to take this time to talk about cost of acquisition, which is a metric that's very important in finance because it talks about how much we spend to actually acquire new members. And there are a bunch of singular product companies like Chime, where they offer a checking account where they can benefit off of their clients actually spending and saving. Or maybe even a higher margin company like Happy Money, where they actually make money off of giving out personal loans and then earning interest off of the money that people are borrowing. These singular product companies usually lead to lower customer lifetime value, or CLV. This metric is extremely important in finance as it measures how much money a client will bring in over a multi-year relationship with the company. Now, SoFi specializes in this, and it might be my favorite part of the entire business. But whenever a business has multiple products like SoFi does, the customer acquisition cost stays low because you've already acquired the customer, but then you can cross-sell it to other products, meaning that the customer lifetime value continues to climb even though the actual expenses stayed low. This is a massive advantage for SoFi and how they plan to scale and grow their company going forward, as they can keep expenses low while also achieving an industry-leading customer lifetime value. A survey done by Go Bank Rates shows that around 50% of Americans only bank with one single institution. This just goes to show you how large legacy banks can continue to charge high fees and offer no interest rates within their products because people don't like to shop around for their banking institution products. This 50% of Americans will be a very hard market to penetrate, but not impossible. Within the other 50% of customers that actually have multiple bank accounts, 81% of this can actually be disrupted. These people are using multiple account balances because they want things like more products, flexibility, lower fees, and higher account balances, all of which SoFi can offer because of their digital-only services and having a bank charter license. And SoFi is going to be a large beneficiary of this massive changeover to a digital-only banking lifestyle where people are trying to fix their financial health. SoFi gets massive publicity from SoFi Stadium due to having large crowds such as the Super Bowl, the BTS concert, and as well as the FIFA World Cup that's coming up. And SoFi also just gets tons of attention and praise from reviewers and blogs online that people trust that are giving SoFi a perfect 5-star review on different products across the board. Now, we have only spoken about one segment of SoFi's total business. Let us not forget about their financial technologies business with Galileo and Technisys. This is where we give companies an easy-to-use suite of products that allows them to join in on the financial services movement of going digital-only banking. These products can include payment processing services, credit card offerings, core banking and ledger balance integration, and everything in between. And although we're giving the ability to let these companies make their own cash management accounts, let's not forget that they still need a sponsoring bank to be able to have the custodial rights to this cash. This is where SoFi Bank will also be able to help out, which just adds on another fee to this whole operation. Oh, and by the way, every single neobank that I listed above, including Robinhood, also uses Galileo for their services. So yeah, they're paying us too. And Galileo's growth alone is nothing to scoff at, as they've more than tripled since we acquired them just back in 2020. This is the definition of vertical integration. SoFi has created a full stack of products that all work perfectly together that no other company in the world has been able to recreate. This is due to a technical and regulative nightmare that SoFi has had to go through over years of trying to get this achievement. Now they have it, and companies are going to have to take a very long time to be able to try to recreate this. And these same systems that SoFi can offer their Technisys clients, like the core banking and ledger balance technologies, is the same ones that we're using on our own technologies as well, but obviously without all the fees. Switching gears here for a second, Amazon is actually a very interesting comparison whenever you're comparing to how SoFi would like to grow its business. Like, yes, I know that they have very different business models, but the idea of having a customer-facing business like Amazon Shopping or SoFi Bank that have extremely low, impossible to beat margins, this coupled with the idea of having a back-end technology platform like AWS or Galileo and Technisys is focusing on selling products to other businesses that have higher margins that allow their customer-facing business to continue to have very low margins and focus on growth through acquiring new customers. The CEO of SoFi, Anthony Noto, has gone as far as to say that SoFi Technologies is the AWS of FinTech. SoFi's competitive advantage is also in their big picture ideas. While we compare the differences in SoFi's businesses versus other businesses in North America, SoFi has slowly been expanding globally into SoFi Hong Kong and now Singapore. But that's only for their banking services. Galileo and Technisys are starting to go completely global, actually reaching places like South America, Europe, and even Asia. Now, that doesn't necessarily add to their competitiveness whenever going face-to-face against competitors like Varo, but it does expand the overall total addressable market of what SoFi can go after years down the line. But if this alone doesn't convince you, maybe you should check out why now might be the best time in history to buy stocks. But don't forget, if you haven't already, to like this video and subscribe down below if you want to see more financial content just like this.